Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Anthony Chara. Thanks for being on the show, Anthony.
Thanks for having me, Whitney.
Anthony's a real estate investor that has successful investing and property management experience dating back to 1993. Mr. Chara turned to apartments full-time in 2004 and currently owns or has syndicated over 1,800 apartment units with a total asset value in excess of $43 million, ranging from 31 units in Pennsylvania to 410 unit for property portfolio in Indianapolis. Presently, he's managing partner of Apartment Mentors LLC and founder of Success Classes LLC. Now, thanks again, Anthony, for being on the show. And why don't you give the listeners a little more about your background and where you're from and what you're currently working on?
Sure. So I grew up in Southern California. I moved to Denver, Colorado, which is where I live right now, in 1984. And started my real estate investing career in 93, as you mentioned earlier. That's when my wife and I turned our first home into a rental and moved into a larger, nicer home. And for about 10 years, all we did was single family rentals because that's all we knew. And then I went to a Robert Allen conference, who's actually a speaker at another conference I was at, and I signed up for his program and then learned that you could do things like wholesaling and fixing and flipping and foreclosures and short sales and even apartments. And started down the path on apartments. At that point, I actually met another mentor here in the Colorado area. His name is Ron. And Ron taught me a lot of what I now know and utilize to buy apartment buildings. Been doing that since, like I said, apartments since about 2004. Got up to 1,800 units at our peak. Let's see, what are we working on now? Working on all kinds of stuff because I actually teach people coast to coast how to buy apartment buildings. So we're working on, we've got 60 units that we just bought a couple months ago in Iowa. I've got students working on a 54 unit in Michigan. I've got other students working on 100 unit properties, 125 unit properties, 60 unit properties, 30 unit properties all over the country.
Nice. So, you said you're teaching students all over the country. Tell us, what's a common problem you see that students have maybe getting started in this business?
Sure. I think the biggest common problem I see is actually there's two of them. One is people don't think that they can do it. They get stuck in that single family home world and they're afraid to make that jump from single families to apartments. I certainly had a little apprehension when I started with it at that point back in 2004 because I had never done it before. So there was a little concern on my part, but I took a leap of faith. I listened to my mentors, both Robert Allen and Ron, and started going out and buying them. And I think along with people not understanding that they can do this, one of the biggest factors is the money because you're basically adding another zero to what people are used to when they're buying single family homes. So instead of a $100,000 home, you're buying $1 million property. Instead of a $50,000 home, you're buying a $5 million property. And when you start adding those zeros, and you're probably well aware of this since you're doing a syndication podcast, there's a lot of people that don't understand that you can actually go out and raise money from other people to get your deals done. It doesn't all have to be out of your own pocket. So those are the two big things, is just the mental aspect of taking that leap of faith and moving forward with apartments. And understanding in a lot of cases is actually easier than single family homes. And then the second one is being able to raise a large enough sum of money in order to buy larger properties.
Nice. So could you help the listener that's in those same shoes right now that says, I just don't think I can do it, or they are afraid to jump from, the single family mindset to apartments? How do you help that person?
Sure. Well, it really does start with the mental aspect. The 6 to 8 inches between the ears is the biggest problem that people have to overcome. It's not how much money you have in your bank account. It's not the education that you have from school, whether you didn't even finish high school or didn't finish college or anything like that. Doesn't matter what kind of job you have. The main focus is right here. It's you have to believe that you can get it done first. So along with that, I do believe that education is very, very important. Whether you take one of my classes or somebody else's class, you need to understand what it is that you're trying to accomplish and how to get there. And once you understand what you're trying to accomplish and how to get there, raising the money and getting these bigger deals done should be fairly easy.
Nice. So why don't we walk through a recent deal maybe that you did with the student, and I think that would be a um, good thing to talk about. So, the listeners are probably in some of those same shoes. So, if you want to do the 60 unit now or 54 in Michigan, either one, it doesn't make me any difference. So,
Sure.
why don't you start us, where that student kind of started from, what was their background? Give us just a little brief, briefing on where they were at in this journey when they started this 60 unit or 54.
Sure. Well, the 60 unit was actually done by a couple of my students who have already done a couple of other deals. And the way that they found that particular deal was through the relationships that they created with people in the market. The one student who's what I call the lead on it, his name is Dave. He already owned another property in this town. It's called Burlington, Iowa. He already owned another property. He had connections with real estate agents in that area. And he kept bugging the one real estate agent that he had a really good relationship with. He kept telling him, bring me a deal, bring me a deal, bring me a deal. And one of the struggles that he had in that particular area was this same real estate broker is also a competitor because he buys his own properties. So all of a sudden he shows up and says, hey, here's a 60 unit deal down in Burlington, and are you interested in it? Of course, Dave's first question was, wait a second, I know you buy these kinds of properties, so why aren't you buying this one? Why are you bringing it to me? Because usually the red flags go up, the hairs on the back of your neck go up. It's like, okay, wait a second, something doesn't seem right here. And what he told him was, number one, it was too small because he only buys properties that are over 100 units, in some cases 150 or more. And number two, it was too far away from his target market. His target market is about 2.5 hours away, and he just didn't want to have to deal with it because it was too small. So that made perfect sense. So Dave went out and visited the property, started putting the numbers together, put them through my quick analysis software, and realized that this property was a killer deal, specifically because the current owner of the property, or one of the current owners of the property, was also the property management company. And because of that, they were charging not only their regular management fees, they were also charging their fees to manage the entire investment or be what's called the asset manager for the team of investors. And so their management fees, when you added everything up, came to over 27% of the income that was generated on the property, wow, which was outrageously expensive. So what Dave Dave did is he went out and he started looking for other students that he's known and he's partnered with before and said, hey, I've got this new deal. Are you interested in partnering with me? A couple of them came in and said, yep, absolutely. They started looking at the numbers, started doing the due diligence, realized that in their target numbers, all their goal is only to lower the expenses, because the expenses were coming in close to 70%. So 70 cents of every dollar that was coming in for rent was going back into the property for expenses. Their goal was to do nothing but lower the expense ratio from 70% to 60%. And by doing that, the property we have, we bought it for just under 1.8 million. And just by lowering the expenses 10%, the property value jumps up to about 2.4 million.
Wow.
So yeah, and we needed to raise $600,000 for the closing costs and some rehab work. There's actually about 150 some windows that need to be replaced. So we need to raise $600,000 for closing, attorney's fees, legal fees. We also did a syndication. We went to our syndication attorney, and she charged us a little less than, it was about $10,000 or $12,000 to put together syndication. That was all included in the $600,000. We did a couple webinars with my list and with Dave's list, and we raised $600,000 in about 2 or 3 weeks.
Nice. So I was going to ask you, how a student like that would raise $600,000 or more for a deal, when they're just getting started. Could you help us with that a little bit?
Sure. Well, there's a couple different ways you can do it. There are people out there that can help you, but you do need to be careful. There are some people that say they can help you, but they're not a licensed broker. They don't have a securities license. And in order for you to pay them, you need to make sure that you only pay them a referral fee for anybody that they send to you. They're not allowed to talk to anybody about the deal at all. All they can do is say, you know what, Whitney, Anthony's got a great deal. Anthony, Whitney's got money, talk. And that's it. But then there's other people who do have a securities license, just like stockbrokers do. They have a securities license. They can actually go out and sell your deal to other people. Now, I don't have a securities license, but one of the ways that I'm brought in with my students and I help them raise money for their deals under certain circumstances is they give me a piece of the deal. And by me having a piece of the deal, now it's not their deal, it's our deal. And because it's our deal, I'm able to go out and help them raise money for our deal, and I can actually talk to someone like you and say, hey, Whitney, here's the reason this is a great deal. The expenses are really high. All we're going to do is lower it to this amount. We still think we've got room to lower them further. And as long as we hit these different target points, this deal is going to be worth $2.4 million in about a year. So about a $600,000 increase in equity by doing nothing but lowering expenses. So that's one of the ways you can raise money, is partner with someone else who's already done it, give them a piece of the deal. In exchange for them being part of the deal, they can help you raise money for your transactions. One other quick note of caution, though, is you do want to have in your agreement, because there are some people out there that tell you that they can help you raise money and then they don't go do anything. So in your agreements, what's called your operating agreement or your private placement memorandum, there needs to be a provision in it called a clawback provision. The clawback provision, and you can talk to your SEC attorney about this, the clawback provision allows you to literally take some or all of your ownership stake that you gave to somebody back if they don't perform based on what they've agreed to do.
Nice. I appreciate you bringing that up, the clawback provision. That's really good to know. So if someone doesn't raise that capital, then they don't still get the same percentage of ownership that you first allotted to them, correct?
Correct. Yeah, I had another student. We actually raised over $1.7 million to buy 2 fourplexes out of the country, actually down in Belize. And on his second deal that he did with someone else, that other person never did anything. They had partnered as equal partners, and the person never helped them raise a dime, and he ended up losing that deal. And fortunately, he didn't lose that much. He lost, I think it was about a $10,000 option fee on the fourplex. But after that one fell apart, that's when he contacted me, and we went out and did one, and we did very, very well. We raised $850,000 within a couple of weeks, and he liked it so much he wanted to go do another one. So we partnered up on a second one. He actually owns 4 of them, 4 fourplexes down in Belize, but I only partnered with him on his last 2 because he was out of potential partners in himself. So I have a much bigger database. And so that was good. But in his case, it's probably a good thing that the whole thing did fall apart, because he did not have a clawback provision. And that's another thing you have to be careful of, is sometimes people they might come to you and say, hey, Whitney, for every $100,000 you help me raise, I'll give you 1% of the deal or 2% of the deal, something like that. Well, that's too much like a commission. That's why you need to just give somebody an ownership stake, because now it's your deal, right? Yours and theirs. But then you claw that back, you pull away the piece, either all of it or some of it, depending on what they're not able to do. And again, that I don't want to get into legal mumbo jumbo, because I'm not an attorney. You need to talk to a good SEC attorney who can help step you through that and make sure that the correct wording is in your agreements.
Tell us about how this deal, the 60 unit, was structured. Tell us, how to structure this deal and why it was structured the way it was.
Well, let's see if I can remember it exactly. So the 60 unit, I think there's 5 or 6 of us on what we call the management side of the deal. So there's Dave, who's the main person. Dave got 10% of the deal because they found it, they negotiated it, got it under contract, helped with the due diligence, they helped raise money, and in exchange, he got 10%. One of the other people that Dave brought in, his name is Mike. Mike agreed to be the asset manager. The asset manager is the person who's not the property manager, but they oversee the entire operation. They manage the property manager. They hire and fire the property manager. They direct the property manager on what they should and shouldn't be doing. He also had someone else who wanted to be in the deal, and that person didn't want to put any more money in, even though he had money. He just wanted to use his time to continue to learn and add to his knowledge. So I believe he got 2% of the deal for providing what's called sweat equity. Oh, Mike, on the other hand, Mike also got 2% for being the asset manager. Dave also gave me, I believe it was 8% of the deal to help him raise $600,000. And as far as I know, I think I was the one, or at least my sources were the ones that came in with all $600,000 for his particular deal. So didn't have to worry about the clawback provision, because we did what we said we were going to do. Let's see, I know I'm missing somebody else. There's Dave, there's Mike, there's Dean, there's me. Oh, the credit partner, a lady named Andrea. Andrea came in as a credit partner, and she got another 10% of the deal. So when you add up all those totals, you got 10, 20, 14 plus me, so 22%. So that leaves 58% left over. So what happened is then the other additional 58% went out to the money partners. So the people that actually brought in the $600,000 of investment, they split up the other 58% on a pro rata basis, depending on how much they invested in the deal.
Nice. Nice. So, and going forward, like, as far as how investors are paid, I've had numerous questions on social media lately about how investors are paid after the deal is closed. Could you just go through that a little bit and how that works?
Sure. There's a variety of ways that they can be paid. Most of the time with our deals, we tell our investors in the operating agreement that we plan on paying them at least once a year, but the goal is to pay them quarterly. So as long as the property is performing the way that it's supposed to perform, and we have enough reserves set aside so that we don't get caught with our pants down in case there's some major expense that comes up that we weren't prepared for, which does happen, we then send out a quarterly payment to our investors. And matter of fact, we don't even actually send it ourselves. What we do is we send a spreadsheet to our property management company, because our property management company pays all of our bills. And in that spreadsheet, it says, pay John Smith this amount, pay Sally Jones this amount, and it goes through every single investor, and then they just print out the checks and send them out. That's one way you can do it. Another way you can do it, depending on the deal, because I have a student in Southern California whose name is Frank. Frank works with a lot of people who have IRA money. And because they're using IRA money, they can't really use that money anyway. So they don't really care if they get a whole lot of cash flow. Well, he brings in his investors strictly as debt partners. So they don't even get an equity stake in the property. They just get debt, but he also sets it up in such a way, because they don't need the money on a quarterly basis or even an annual basis. He just sets it up that he will repay them what they invested plus X% of dollars. So I think he's paying them 5 or 6 or 7% interest, but he collects that over a 3 to 5 year period, because between 3 and 5 years after they purchase the property, they plan on either selling it or refinancing it. And through the sale or the refinance is where the money comes back in to pay off the investment partners plus their stockpiled interest payments for the 3 to 5 year period. Back on Dave's deal and most of the deals that we do, you're asking about how they get paid. Number one, most of the time they do get paid a percentage of the cash flow. So as the cash flow comes in on a quarterly basis, we send out distribution checks. The other way that they get paid is they also participate in our deals. Not like in Frank's deal, they're just straight debt partners like a bank. You just pay them off and they're done and they go away. We bring in what are called equity partners. So our equity partners not only get the cash flow from how well the property is performing, but when the property is either sold or refinanced in the future, they also get a percentage of that. So we might have investors that are getting anywhere from 8 to 10 to 12% cash on cash return, but by the end of the transaction, somewhere in the actually more like 5 to 10 year period of time frame, they're also going to get a big chunk of equity, assuming that we don't do a 1031 exchange into another property, and they may end up with an extra 15 or 20% per year return because of all the equity that's built up in the property too.
Nice. I appreciate you explaining the debt partners versus equity partners. And, what's the hold period plan or, long-term business model for the 60 unit?
Sure. The 60 unit is I believe that one is a 10-year hold. We actually are in the process right now. We got a bridge loan on it to start with, because a bridge loan is, by the way, if you don't know that, it's a fancy term for hard money loan when it comes to commercial property. So we have a bridge loan in place right now because we were having issues with the financials from the seller when we first bought the property. So now that we own it, we're going to be going out to HUD and getting a HUD loan on this particular property. And because of that, the minimum hold period on the HUD loan is going to be 10 years. There's a 10-year prepayment penalty, which means if we sell it anytime before that 10-year period is up, there could be some very large prepayment penalties, which we don't want to have to pay. So we'll probably own it basically about 11 years, because we're going to go about the first year with our bridge loan, because whether we refinance it in 6 months, 10 months, 12 months, we still owe them the same amount of interest. So we figured we'll just go ahead and maximize that out for the full 12-month period. And right about now, actually, we are starting the HUD process to have that loan taken out sometime early next year with a HUD loan. So the 60 unit is a 10-year hold. Most of our loans balloon in 5 years. So the way our private placement memorandums are worded and the operating agreements are worded is when the loan balloons, in most cases 5 years, we go to the investors at that point and we ask them what they want to do. do you want us to refinance the property and hold it for a longer period of time, or do you want us to sell it? And then based on that vote, we either refinance it or we sell it.
So you're giving the investors a vote on numerous things, or just when they sell or keep the property?
Yeah, when we first started up, we had limited funds. We were raising money for a $300,000. Well, we were raising $300,000 to buy into a 100-unit, actually a 98-unit apartment complex. And we went to SEC attorneys and said, hey, we need to raise $300,000. How much is that going to cost? And most of them told us it was in the $25,000 to $30,000 range. And this was 12 years ago, 11 or 12 years ago, when our first couple of deals that we were syndicating. And we said, well, we can't justify paying $25,000 to $30,000 to only raise $300,000. Is there another way that we can do it? The other way that they suggested we do it is by just having an operating agreement and keeping everybody active. Every single partner active in the deal means they had to actively vote on everything. If we wanted to change property managers, they had to vote on it. If they voted to replace the property manager, then the next vote was, okay, who are we going to hire to replace the one that we're firing? And of course, if they vote no to not get rid of the property manager, then we're done. We can't move anywhere from there. We want to paint the building. We had to take a vote. We had to take a vote to see whether or not we wanted to paint it. And then we had to take a vote to see who we were going to pick to paint it. And then the third vote was, what color are we going to paint it? It was a pain in the butt. So all of our new documents, but in order to do it that way, we were only paying $2,500 to $3,000 with the caveat that everyone had to be actively involved. We've now buying larger properties, raising more money, so it made more sense to transition into a full-blown private placement memorandum. And nowadays, we have one person who's the asset manager. That asset manager makes 99% of every single decision that needs to be made. There's only two votes that the investors get. The first vote is whether or not they want to keep the asset manager in place. If they don't, they can vote to remove that asset manager and vote to put in somebody new. That's one vote. The second vote that they get is when we decide whether we're going to sell it or refinance it. So the operating agreement specifically states this is when the loan is going to balloon, and at that time we're going to ask you for your feedback to see whether you want to refinance it or sell it, and that's what they get to vote on. And that's it. Everything else the asset manager takes care of.
All right, so changing gears a little bit, somebody just getting into this business, let's say they may only have their own home, or maybe they have a couple single family homes. What's the best advice you give them, in 30 seconds?
Education. How was that?
That's good.
You have to get educated. You can't assume that you're going to jump from a single family home and all of a sudden go out and buy a 20-unit apartment complex. It's completely different. Even if you own your own home and have one single family home rental, going from one single family home rental to a 10-unit apartment building or a 12-unit or 20-unit or 50-unit, completely different animal. You do get different types of residents in an apartment compared to a single family home. A lot of people that rent single family homes have what I call homeowner mentality. Maybe they did own a home and something happened, or maybe they're just moving into a particular area and they haven't been able to find their new home, and so they want to rent a home right now so they don't have to worry about being connected by walls to a whole bunch of other people, which is what you get in an apartment complex. And so you need to get educated not only on the way that apartments are valued, which is completely different than single family homes. You also need to get educated on how they're managed. Who's going to manage that property for you and what kind of qualifications do they have? So those are the two biggest things. And again, they both come back to education. You have to go out and read books, listen to podcasts, go actually to live education. I have a lot of people that I know that love going to different websites and reading on stuff and asking questions. I said, well, yeah, but there's a lot that can be said for going to somebody's 3 or 4 day class and learning through a boot camp process, because there's a lot of questions that you don't even know you should be asking. So it's great that you can go to a website and put a post out there and get a bunch of people to respond, but there's probably, for every question you ask, there's probably 1,000 that you don't even know you're supposed to ask.
So what's been the hardest part of the syndication business or process for you?
The hardest part. I think the hardest part for me was, number one, was getting started. There's always that fear factor when you do something new that, oh my God, am I going to be successful? Do I know what I'm doing? Well, again, that's where it comes down to getting educated. I have a very good SEC attorney who steps me through the entire process. It also comes down to just, and you're gonna morph over the time that you're doing this. How we did things 10 or 12 years ago when we first got started is completely different than how we do things now, because we've learned from what we've succeeded at and what we failed at when it comes to raising money and how we approach things. There's certain things that you can't say on a webinar when you're trying to raise money or when you're talking to somebody that you just knew. There's things that you should be saying in order to get people interested in learning more and want to actually read your private placement memorandum to figure out whether or not they do want to invest with you. So the biggest things are just get started, number one. Don't be afraid to make changes. The other big thing that I'll tell people too is anytime someone tells you no, that they don't want to invest in your project, always ask them why. What was the deciding factor that they didn't want to invest? Was it the location of the property? Was it the numbers on the property? Maybe it wasn't a good enough return. Did they not like the property location or the property itself? Did they not like the color of the building? And quite frankly, sometimes it's you. Sometimes they don't like you yourself. I actually had one investor years ago. I was helping a student raise money and she said no, and I called her up because like I do that to help my students. I say, hey, I just wanted to see what you liked and what you didn't like about the deal. She loved everything about the deal except something about the person's voice on the webinar. She doesn't know if it was reminding her of some voice in the past, but she just didn't trust that person. She didn't trust that they were going to do what they said that they were going to do. And all she could come back to was it was something with the voice, and she just didn't feel comfortable. So always ask what's going on, always ask why, and don't be afraid to modify what it is you're working on. If you get enough people telling you that they're not going to invest because they don't like the returns, then figure out a way to get better returns or go find another property.
That's good advice. Good advice. Always ask why. I just think you're going to learn a lot then, even if that person never invests with you personally, just like that lady, she didn't like his voice or whatever. However, going forward, that person's probably going to provide you some information to help you better yourself and better your business.
Absolutely.
So tell us, what's the number one thing that's contributed to your success?
Persistence, perseverance, and patience. Three things. How's that? Three things. You don't, you're going to fail at things that you do. Don't let failure set you back. Just because one person said they wouldn't invest with you doesn't mean 10 other people won't invest with you. That's why I said you always have to ask why when people won't invest with you, because if you start to see a pattern, if one person says they won't invest with you because the returns aren't high enough, I mean, I've showed people where the returns might average about 12% a year, and they tell me that's not good enough. It's like, really? Yeah, I want 25 or 30% each year, year in and year out. It's like, wow, okay, great. I'm sure there are some investments like that out there. Matter of fact, I know some people that do hard money loans that get those types of returns, but it's not for the full year. It's on that one deal for a 3 to 6 month period. And then their money's not being used, and then they've got to go out and find another deal to make another loan to make another huge return on their money. Anyway, so you need to be patient, you need to be persistent, and you need to persevere. There are going to be setbacks. You need to continue to move forward. So as I started to say, if one person says that the returns aren't high enough, that's just one person. But if you have 3 or 4, now you've got a pattern. So what can you do to change the returns? If you have people that say they don't like the area, well, you can't pick the building up and move it to a completely different area, but at least they like the deal, they like the numbers. If you could find that same exact property in a completely different area, they'll probably invest with you. The other thing I would say that you're going to need to overcome is occasionally I've got 2 or 3 people that have been on my webinars for probably a good 8-10 years. They have never invested with me ever. But they keep coming on the webinars, they keep learning, they keep listening, and then they never, ever do anything with it. And I don't know if they're just looking for free education so that they can go out and do their own deal or what the deal is, but I would have better things to do if I was going to be on dozens and dozens of webinars and never take any action whatsoever to invest in a property. There's other things for me to do.
Got to take action, right?
You have to take action.
So tell us some way that you've recently improved your business that we can all apply to our business.
Recently, recently improved my business? Actually, I think one of the things that we did, it wasn't too recently, because we've been doing this for quite a while now. We've been doing this for 14 years. Probably about 3 or 4 years ago, we changed the way that we do our presentations. So there's 3 main things that we now want to highlight when it comes to doing a presentation to people to entice them to want to learn more about and possibly invest in our deal. One of the first things we do is we talk about the team. Who is the team that's going to be responsible for this asset? Who's the asset manager? Who are the managing members? Is there a credit partner? What are their backgrounds, and why should we even be interested in investing in this deal? If you bring somebody who has absolutely no background, no experience, no nothing, and they say, hey, I'm trying to raise $500,000 for my deal, there aren't a lot of people that are going to invest in that, except for maybe family and friends that know you, like you, and trust you. But if you can bring a team of people and start with and focus on that team first, that's very, very key. The second thing that we do in our presentations is we then focus on the area. We focus on the area of town or the city where that property is located, and we show them what's going on. We show them the major employers, especially if they're hiring, bringing on more people or expanding into that market. You know, right now, the big thing going on, everybody was all up in arms about Amazon. Where's Amazon going to put their new headquarters? Well, they ended up splitting it between New York and just outside of Washington, D.C. Well, as soon as that news went out, property values in the DC area went through the roof, where Amazon, or the area where Amazon is going to be putting part of their headquarters. But if you, those are the types of things, if you know that that's going on in your area, and it doesn't have to be Amazon, it could be anybody. Major employers that are hiring, what's going on with wages, wage growth, what's going on with population growth, what's going on with occupancy rates and construction, new construction when it comes to apartments. And in that particular area of town, you can basically let people know, here's why it's a really good area. So we start with the team. We then talk about the area where the property is located. And then the third leg of that stool is the actual property and the numbers for the property and why the property makes sense. What is it doing right now today? And what are we going to be doing with it tomorrow to enhance the value for ourselves and for our investors, for them to see and understand why they would want to invest in this, because in the next 2 or 3 years, we're going to increase the value and or the cash flow exponentially.
And what platform do you use to do your presentations with?
We're using GoToWebinar.
GoToWebinar. Awesome.
GoToWebinar, yep. And as I mentioned earlier, very briefly, there's certain things that you can say and things that you can't say. So get together with your SEC attorney to learn what you can and can't say. We do have 3 different presentations that we do. I have what I call my inner circle group, which are students that have been to my boot camps that I know, have known for quite a while. We show them everything because that's what they paid for. So they get to see all the returns, how much we're raising, all the projections, everything. Then our second and third levels, because we don't have a close relationship with those people, we can't talk to them about how much we're raising. We can't talk about projected returns. And we can't talk about a lot of things with the deal when it comes to the numbers until they complete something called a investor questionnaire, which you get from your SEC attorney. They complete the investor questionnaire, they return that to you. It tells you a lot more about their level of investing experience, their level of risk taking, whether they're accredited or unaccredited, so on and so forth. And then once you have that document, now you can actually go out to those people and have a more detailed conversation with them.
That's great, Anthony. You've been a fantastic guest. I appreciate all the information and content you've provided to the listeners. Would you tell them how they can learn more about you and your company?
Sure, absolutely. They can go to our website. They can go to apartmentmentors.com, apartmentmentors with an S, apartmentmentors.com. They can learn all about me, classes. Not only do I do the classes on apartment investing, but we do have additional classes on structuring your deals, asset management, due diligence, buying value play properties, how to find them, how to analyze them, and basically do what you're asking me to do, which have asked me to do, which is to show people how they structure the deals and how you raise money and that kind of stuff. So all kinds of education.
I hope the listeners will connect with Anthony and learn more about his classes, and so you can continue to educate yourself so you can take action and get into this business. Hope you'll go to lifebridgecapital.com and connect with me and sign up for a call and or go to our Facebook group so we can all learn this business together and learn from experts like Anthony. Thank you again, Anthony. We will talk to all the listeners tomorrow.
Thank you, Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.